For years, they called crypto a bubble. Too volatile. Too risky. Too speculative. And now? One of the most powerful banks on earth is holding it. Not a little. A lot. Goldman Sachs. Bitcoin. Ethereum. Solana. XRP. The same assets retail investors were mocked for buying are now sitting inside institutional portfolios. So, what changed? And what does this mean for you? Let's break it down. The Wall Street shift. There was a time when Wall Street laughed at crypto. Then they ignored it. Now they're allocating capital to it. Goldman Sachs isn't a startup. It's a global financial powerhouse. When an institution like that builds exposure to digital assets, it's not for hype. It's strategy. Big banks don't chase memes. They chase asymmetric opportunities. And crypto is no longer fringe. It's infrastructure. Bitcoin. The foundation. Let's start with the king. Bitcoin. Institutional interest in Bitcoin has grown massively in recent years. Why? Because Bitcoin is no longer viewed as just a speculative coin. It's viewed as digital gold. Finite supply. Global liquidity. Decentralized. For banks like Goldman, Bitcoin represents macro positioning. A hedge against currency debasement. A hedge against instability. A hedge against the unknown. It's not about hype. It's about portfolio insurance. And when institutions accumulate, they think long-term. Ethereum. The engine. Then there's Ethereum. If Bitcoin is digital gold, Ethereum is digital infrastructure. Smart contracts. DeFi. Tokenization. Stablecoins. Ethereum powers the majority of decentralized finance activity. For a firm like Goldman Sachs, that's interesting. Because tokenization of assets, stocks, bonds, real estate, could transform finance. Imagine traditional securities settling on blockchain rails. Faster. Cheaper. Transparent. Ethereum isn't just a coin. It's a financial operating system. And Wall Street sees it. Solana. The speed play. Now let's talk about Solana. High speed. Low fees. Built for scalability. Solana represents the next layer of blockchain performance. Institutions aren't blind to innovation. If Ethereum is the dominant ecosystem, Solana is the high-performance competitor. And in tech, competition matters. Banks allocate across ecosystems not because they know the winner, but because they know adoption is growing. Solana's rise signals that blockchain is evolving. Fast. XRP. The banking bridge. And then there's XRP. This one is interesting. Because XRP has always positioned itself as a bridge for cross-border payments. Faster settlements. Lower costs. Global transfers without traditional friction. For financial institutions, that matters. International transfers are expensive and slow. If blockchain can reduce that friction, it becomes useful. And utility is what institutions care about. Not noise. Not narratives. Utility. Why this is a big deal? Let's zoom out. When retail buys crypto, it's speculation. When institutions buy crypto, it's validation. Goldman Sachs managing exposure to Bitcoin, Ethereum, Solana, and XRP signals one thing: crypto is being absorbed into the traditional system. Not replaced. Integrated. That changes the risk profile. It reduces stigma. It invites more capital. And capital changes markets. What most people miss: here's the part nobody talks about. Institutions don't just buy and hold. They build products around assets. ETFs, structured products, custody solutions, advisory services. When banks hold crypto exposure, they are preparing to serve clients who want it. That means demand is rising. Quietly, behind the scenes. And once products are built, distribution begins. That's when things accelerate. Retail versus institutional timing. Retail investors often move on emotion. Institutions move on cycles. They wait for clarity, regulatory progress, market structure, liquidity depth. When those boxes get checked, capital moves. And it moves big. Goldman's exposure isn't about headlines. It's about positioning before the next phase. Because institutions don't chase the top. They accumulate during consolidation. What this could mean for prices now. Let's be realistic. Institutional holdings don't guarantee price spikes tomorrow. But they do change supply dynamics. Long-term capital tends to hold. Less panic selling. More structured positioning. As more institutions enter, volatility may decrease over time. And legitimacy increases. Crypto shifts from speculative tech bet to emerging asset class. That transition is powerful. The bigger transformation. This isn't just about one bank. It's about the merging of two financial worlds. Traditional finance and decentralized finance. For years they stood apart. Now, they're converging. If major banks are holding Bitcoin, Ethereum, Solana, and XRP, then crypto is no longer outside the system. It's becoming part of it. And when that happens, adoption accelerates. Dramatic close. For over a decade, crypto was called an experiment. A trend. A phase. But when institutions like Goldman Sachs hold massive exposure, it's no longer an experiment. It's allocation. The same assets once dismissed are now sitting inside the portfolios of financial giants. That should make you think. Because when Wall Street positions quietly, history shows something tends to follow. Momentum. The question isn't whether crypto is being noticed. It already is. The real question is, are you early to the shift? Or watching it happen from the sidelines? Because when the biggest banks in the world start moving, they rarely move without a reason. And sometimes, that reason changes everything.